Welcome back to the Williams Real Estate Channel. Today we are discussing how to scale a property portfolio. So I've developed two phases to this portfolio, and it's basically what I would do if I was to start again from scratch today in the current market. Phase one is starting from scratch, or if you've already got a couple of properties. I'm helping a lot of people these days who have already bought a couple of properties and have got to a stage where they're unsure or they're stuck to how to scale to that next level. I'm an advocate for all types of property. Everything works if it's a unit, villa, townhouse, house, duplex, blocks of units. Everything works well in a well-diversified portfolio, diversifying across 2 to 3 states, diversifying across types of properties is key. Obviously, not going and buying new stuff, especially new and off the plan or house and land packages. We steer away from that stuff. It's all established blue collar, working class type of stock that you can buy well under the replacement value, strong yields of 6 to 8%. We don't look at anything less than 5. That's our cutoff, but everything's typically between 6 to 8%, depending on the purchase price and condition. Location will drive that yield. But this is essentially phase one. And we start by buying a unit, 1 or 2 bed unit, then a villa townhouse with a little courtyard. Once you're into a couple of them in the likes of Sydney, Melbourne, Brisbane, we then like to move out into the regions to buy houses on large parcels of land where it'll give you that opportunity to do a small development if it's putting a granny flat or subdividing it to build a second house. Once you're in a couple of those houses, we then like to move on to a duplex, which is 2 units on one site, and then leverage the growth into a block of 3 or 4 units. Then you have your solid all-weather residential foundation portfolio, 10 properties within a 10-year window. You don't need big bucks, can get you going. And you leverage from one deal to the next and keep growing and building and compounding your wealth. You don't need big bucks to invest in property. You can just get in and then let the market do the heavy lifting, and provide you can buy property well under the replacement value with strong yields in growth corridors that is timing the market well. The market will do the heavy lifting, and you can leverage your growth, and the rents will continue to run, and it just snowballs. This is phase one. Once you've got to phase one, you may want to pull up stumps there, let the rent pay off the debt, hold unencumbered portfolio. You may want to try and buy a family home by leveraging the portfolio or selling down some to buy the family home. You may want to look at commercial properties. If you want to keep scaling, I've got phase two. Phase two looks like this. It is easing into commercial property. If you buy more than 4 units on one site, so a block of 5 or more, it's considered a commercial asset in the bank size. You'll need a lease doc loan where they add up all the rental income from the leases, and then they'll lend according to how much rental income it's bringing in. Typically, you buy this type of stock in a trust. You have to set up trust structures. And this is a great way to ease into commercial, because essentially it is still residential property. It's affordable stock. You always find a tenant to rent. And even in times of crisis, demand shifts to this type of stock. People just need a roof above their head. So you always find a tenant within a week or two. If it's vacant for more than a couple of weeks, the rent's too high. You just need to drop it slightly, meet the market, and you'll rent it out straight away. It's not like commercial property, like retail space, warehouses, industrial, medical centers that can go vacant during times of crisis, during recessions like the COVID, the GFCs, the 91 recession we had to have. During these large recessions that come around every 7 to 10 years, we go through a downturn. Commercial property can go vacant for 2 to 4 years. So this is a good way to ease into commercial when you've already built your solid residential foundation and you're wanting to move into larger deals and scale, buying blocks of units. So blocks of 5s to 7s, and then you can go blocks of 8s to 10s, blocks of 12s to 20s. So this is good stock to create that solid residential foundation off the back of your smaller portfolio for getting into commercial. So this is phase two. We'll work on a phase three in time, but essentially this is what I'm doing over the next 5 years is I am now selling down my individual properties once they've gone through market cycles and they've hit a limit. Instead of holding them through a stagnant flat period, I'm going to recycle the equity by way of both refinance and or selling down smaller deals to then reinvest into larger properties just like this inside a trust structure. We can also buy them slightly tired, hold them through the market cycle, let them tick over. When it comes to peak market, you can vacate tenants, renovate, push yields, or even sell individually. You can strata title these types of assets. So you can buy in a bulk deal, strata title to then allow you to sell them individually to the full market. Because when you buy them in bulk, it's an investor type of stock. But then if you can strata title and sell them individually, you're opening up to the whole market. So you're selling it to new timers, first home buyers, investors, downsizers, everyone will buy an individual unit, and that's when you can charge a premium, peak market. Hope that helps as an explainer of how to scale a large portfolio in the current climate. Till next time, thanks for watching.